Hello everyone. Let's just wait a few minutes to let everyone join, and then we start in around 5 minutes. Okay, hello everyone. Hope you're all doing well. And let's start the workshop. So, this is the third workshop of our Building Bright Future series, which is called Investment Made Simple. So, within the workshop series, basically, we're working on different topics, we're discussing different topics. Previously, we did a physical workshop in New York City, and today, Think Finance and Green Guru will be presenting this presentation. Yeah, so let's start. So today we're gonna be talking about investments basics like stocks and just comparing different investments, IPOs, and we're gonna talk about the long-term finance like bonds, retirement funds, and how we can actually build a portfolio. So that's what's our agenda is for today. I would like to bring on Shan, who's gonna start off with the workshop.
Hello, everybody. My name is Sean Guru. I'm the founder of Green Guru Project, and let's get into it. So, what is an IPO? An IPO is an initial public offering. So, it is when a private company sells shares to the public for the first time. A good example of this could be Figma. I'm sure many of you are familiar with Figma. It was just on the market, and many people there was high demand for it. So many people bought shares like 60, 70, and then it was a high demand, and people ended up only getting one. So the steps are they have to file for IPO, so they choose underwriters and they get regulatory approval, and then they go public announcement IPO. And the reason they do this is because they raise capital and bring in a lot of revenue. They make more money. PR, there's a lot of public reputation for it, and they allow public ownership. Next slide, please. So investing in IPOs. Should we invest in IPOs? Should we not? Like I just said with the Figma example, the price when it's an IPO can fluctuate a lot. It's not consistent. There's a potential for rapid price changes and risk. And there's early access, but you also get early access to new opportunities which could be to have a new company that you want to have shares in, but you have to be careful because the prices can often be volatile. For example, Figma, everybody was trying to get their hands on Figma, but what happened was the price would fluctuate. For example, its IPO was 40 bucks and then it shot up to 120, then went down, up, and investors, there was rapid price changes and risks. Next slide, please. So what are stocks? Does anybody know what a stock is or would like to give a quick definition before I go on? No? Okay. So what are stocks? Stocks represent ownership in a corporation. So when I buy shares of a stock, right? Let's say Apple stock. When I'm buying shares of Apple, I'm becoming ownership in the company. So essentially, what this means is I own a very, very small percentage of the company. Obviously, Apple's a big company. It's expensive a share. I'm not going to have a lot of shares. So it'd be like 0.0001% of it. And what do we get as the investors? So if the price goes up, we get more money, we generate more revenue. But if it goes down, we lose money per share. And then what are the types of stocks? It's a common versus a preferred stock. So, a common stock is essentially a primarily form of ownership in a corporation. So, you're representing a claim on part of the company's assets and earnings. Then, a preferred stock would be the opposite. So, a preferred stock means that you own it's less than common stock, right? So it's a type of equity that blends the characteristics of both stocks and the bonds, and it offers investors a fixed dividend and priority over the common stockholders in receiving dividends and company assets during liquidation. So it's a more stable income stream and less common, and there's a lot less risk in a preferred stock than a common stock, but you have less stake in the company. and you don't have voting rights in the company with preferred stocks. And that privilege is usually reserved to common shareholders. And then income-focused investments, the preferable stocks are often favored by income-focused investors who are looking for a stable and predictable income stream rather than significant capital appreciation. And then preferred stocks also pay a fixed dividend, which is determined when the stock is issued. So, does anybody know what a dividend is? So, a dividend is when you own a shares of a company, you're getting money back every once in a while. So, it might be a few cents or so. So when you have these dividends, what they do is they pay your money back. Even if the stock is going down, you're still getting that guaranteed percentage dividend back in your account. So a lot of retired people tend to invest in dividends more often. And then another key characteristic of a preferred stock is that it's considered a hybrid instrument because it has features of both the equity and debt. So equity means ownership and debt means the fixed uh, payments. So I want to explain a little bit more about common stocks, if that's okay with you guys. So, like I said, common stock, you have the common share ownership in a company, and then voting rights. You have typically the common stockholders typically have the right to vote on important corporate matters, and then dividends. Shareholders may receive dividends, which are a portion of the company's profits. And then investors can get capital gains, which is profit from common stock through an increase in its market value. And then you also get residual claim, which is in the event of liquidation, common stockholders have a claim on the company's assets only after all creditors and preferred stockholders have been paid. And how do companies use these common stocks? They do by raising capital. So they issue common stock to raise money for investments, expansion, or other business purposes. And then the growth is issuing these stocks allows the companies to grow without incurring debt. And how do investors use the common stock? They buy common stock to own a piece of the business and they benefit from its growth. So, for example, if I own some Apple, like the example I said, I have what, 5 shares of Apple. If it goes up 20 cents a share, I will make 5 times that. Does that make sense? And you also should have lots of common stocks so investors can build a diversified portfolio by investing in individual stocks or through index funds and exchange traded ETFs. You can tailor your different strategies with common stocks, but the risks we should get into of common stocks. Like I said, the preferred stocks have a lot less risk. So the market risk is the value of common stock can decline significantly due to poor company performance or broader market conditions. And then there's also lower priority for payouts compared to preferred because you don't get dividends. Does that make sense to everybody? Umar, could I have the next slide, please? So now we're going to go buying and selling stocks, right? So how am I going to buy and sell stocks? So this is also known as trading, and it means that you're buying partial ownership in a company with the hopes that the value will increase over time. You're not buying it with hopes that the potential money will decrease over time. And how exactly am I buying or selling stocks? You have to use a brokerage firm or mobile banking app to buy and sell stocks. And a broker is the middleman between you and a stock exchange. So, for example, one of the biggest ones, the Dow Jones, New York Stock Exchange, NASDAQ. So the process genuinely follows these steps. First, you have to open an account, and to get started, you will need to open and fund a brokerage account. And you can choose between, there's two different types of brokers, right? There's discount brokers, which are online platforms that charge low or no commissions, and they're geared towards self-directed investors. So, an example of a discount broker would be Charles Schwab having a Schwab account because everything is mobile based and you do it by your phone, right? So I use Charles Schwab, and you buy and sell stocks and bonds on there, right? And then full service brokers, and these firms offer comprehensive investment advice and research, but charge higher fees. And then funding the account is the next step. So once your account is open, you will need to transfer money from a bank account to your brokerage account and then placing a trade. Using the brokerage website or app, you can place an order to buy or sell a specific stock using its ticker symbol. For example, Apple. I like the example of Apple. It's my favorite stock, but you shouldn't have a favorite stock because in case it goes down, then it won't be your favorite anymore. Like I said, you need to diversify your portfolio. You can't invest all your apples in one basket. And the ticker symbol, for example, would be AAPL, which is Apple. And you would choose an order type. So a market order is executing immediately at the best available market price. A limit order would execute only at a specific price or better. And then a stop loss order would be a market order that is triggered if a stock reaches a certain price, which can help limit your losses. And then you set the terms, the stock, the number of the shares, and the order type. And then you see if you make money or if you lose money. Does that make sense? Okay, good. Next slide, please. Thank you. So how do bonds work for the investors? Us, we're the investors, right? So you receive periodic interest, the coupon, and the principal is returned at a maturity, and the bond prices change with interest rates. So when the interest rate goes up, the prices go down. And bonds diversify portfolios and reduce risks. So bonds are way, way less volatile, right? And it's essentially a type of loan where you lend money to an issuer, like a company or government, and you receive um, a promise to be paid back the principal amount. So that's why it's not as volatile. And usually with a fixed maturity date. And bonds are a conservative investment that can provide a stable income stream and help diversify an investment portfolio by offsetting the risks of more volatile assets such as stocks. And how exactly does this work? We're going to have the bond issuer, which is the borrower, and the bondholder is the lender. We'll have interest payments, which is the issuer typically pays the bondholder interest, and it's often called a coupon at set intervals, such as semi-annually. Principal requirement at the bond's maturity date, the issuer returns the original amount of money, the principal or par value, to the bondholder. And yeah, next slide, please. Now I want to talk briefly about retirement planning and retirement investments. So let's get into it. So there's several different plans and funds. So you have the 401k, you have an RII, and an employer versus personal plans. So the difference between a Roth IRA is that a Roth IRA versus regular uh, IRA is one is taxed, one is the not. So you want to prefer a Roth IRA, right? And there's different plans. So you have to start investing your savings early. So you don't want to be spending at a young age. So a retirement fund is money set aside during your working years to provide income after you stop working, and it can be employer sponsored or and then or a government program or just personal saving. And then why should you start saving early? It's because it allows your money to grow through compound interest, right? And it's not volatile like the market as much. So it's a safer idea. And even small contributions over time can grow into a large amount. For example, if I'm making a little amount of money, but I'm still throwing in as much as I can instead of wasting it on a need, uh, you would make a lot more money because it would grow consistently over time. And a common rule is to save 10% of your income throughout your career, but the exact amount obviously depends per person. It can be tailored. And then lastly, what's the difference between a pension and a retirement savings account is that your pension is employer guaranteeing a fixed payment after retirement, And then a retirement savings account like a 401k or an IRA, you contribute money sometimes with the employer benefits, right? So I want to give some examples. Let's talk about money money purchase plan. So a money purchase plan has retire required contributions, and the employer is required to make a contribution to the plan each year for the plan participates. And with a money purchase plan, the plan states the contribution percentage that is required. For example, let's say that um, your money purchase has a contribution of 5% of each eligible employee's pay. You, as the employer, need to make a contribution of 5% of each eligible employee pay to the separate account. A participant's benefit is based on the amount of contributions to their account and the gains or losses associated with the account at the time of retirement. That type of arrangement is different than a profit sharing plan. With the profit sharing plan, you, the employer, can decide that you'll contribute a certain amount, say $10,000. Then, depending on the plan's contribution formula, you allocate that $10,000 to the separate accounts of the eligible employees. Also, in past years, money purchase plans had higher deductible limits than profit sharing plans. So now I want to briefly touch on pension versus retirement plans. So basically, there's pensions are less common today, especially in the private sector, and it differs from plans such as a 401k and who funds the account, who manages it, and the certainty of the payout. So, for example, the pension, which is a defined benefit plan, a preamble of the pension is that a traditional retirement plan was once common where employers promise a fixed monthly benefit for life, but now people lean towards more 401k and other retirement plans. And this is the most prominent type of employer-sponsored retirement plan today in the private sector. And then contributions for the pension is that the employer funds the plan and sometimes with contributions from the employee. But looking at the 401k, the employee primarily funds the plan through paycheck deductions, often with an employer match. Then looking at investment management in a pension, the employer manages the investments on behalf of the employees. So if you're the employee in the pension, you don't have control over your investment decisions, but in a 401k, you choose how your money would be invested. And then what's the investment risk? The employer would be the one bearing the investment risk, which guarantees the payout regardless of the market performance. So it's like your employer in a pension is managing your investments in your portfolio. And then on the other hand, for a 401k or defined contribution, there are other retirement plans, which is more common today. The employee bears the investment risk, and the retirement account's value depends on investment performance and then guaranteed income, the plan provides, so this is for the pension, the plan provides a guaranteed predetermined monthly payout for life after retirement. And the payout amount is often based on your salary and the amount of years you served for that company. And then for the 401k, there's no guaranteed income stream, and you're responsible for managing the withdrawals to make sure your money lasts. So essentially, the key takeaway is that pension leans more towards employer management of your funds, and it's a little less personal. But a 401k or a separate retirement fund, you manage more, right? So obviously, we want to talk lastly, bankruptcy protection in the private sector for the pension. The benefits are insured by the Pension Benefit Guarantee Corporation up to certain limits. And then on the 401k and other retirement plans, it belongs to you and you are genuinely protected from employer bankruptcy. So now I will hand it back to Umar. Thank you.
Yeah, thank you, Sean, for coming in and explaining all the different topics like stocks, IPOs, and retirement funds. So, yeah, that's it for the workshop today. I just want to give a final goodbye to everyone because the workshop is about to end. So the thing is that this is our third workshop, right? In the Building Bright Future series. The fourth one is gonna be on the 13th of September, on Sunday, I believe. And if you guys have not, please fill out the registration form, which I am posting on. I'm sending in the group chat. So just make sure to fill that form so we can actually give you a certificate. Some people did like commented or like went to my DMs asking how we can get the certificate. So basically, because this was a four workshop series, you have to attend at least three of them to receive a certificate. So uh, the fourth one is tomorrow, in like next week. So I hope you guys can join, and if you guys will, then you will receive a certificate. So yeah, that's it just from my side. If you have any questions, please send in the chat so we can answer it for you. But yeah, that's really it from our side. I'll be ending the meeting in around 5 minutes. So yeah, if you don't have any questions, you can leave. But just make sure to fill that form. And the next week workshop will be on internships. The next week we are opening our application forms as well. All four of the NGOs who's working on this workshop will be opening their internship programs, the summer programs. So if you are interested, you can come to the workshop and yeah, get the link of the form or the application form. Okay, so I will be ending the Zoom meeting. So thank you everyone for joining in, and just make sure to join the next workshop if you want the certificate, because then it will be hard for you to get the certificate. So yeah, thank you for joining in. You guys can leave now. I hope you guys have filled the form, the attendance form. So yeah, thank you for coming in, and have a great day. Goodbye. I'm ending the Zoom meeting just now. Thank you. Goodbye. Have a great day, everyone.